Hi, my name is Professor Deanna Martin, and I have a continuation of the financial statements, a little bit more about the components of the financial statements and how they're interrelated. Let's first start with the components of the balance sheet. It's our balance sheet equation. Assets equals liabilities plus owner's equity. In the assets section, we're going to always start with cash. The assets will be prepared in the order of liquidity, which means the closest that's to cash, so we're always going to start with cash. Usually there's going to be things like accounts receivable, supplies, and other current assets like that. AR stands for accounts receivable. The accounts receivable will usually be collected in about 30 days. Supplies will take longer. Supplies will last longer than 30 days, so that's why we're going to put them after accounts receivable. Then we'll have our long-term assets, such as buildings or equipment. In the liability section, the most common liabilities we'll have will be accounts payable and notes payable. Accounts payable is abbreviated AP, notes payable is abbreviated NP. Accounts payable are usually collected within 30 days, and notes payable have a little bit longer, maybe 60, 90, 180 days. You'll know that something is a liability if it has the word payable. There's one weird one in here that does not use the word payable, and it's unearned revenues. The order of the liabilities does not matter because generally accepted accounting principles tells us that we have flexibility in the way we want to order those. The assets, on the other hand, must be prepared in the order of liquidity. In our owner's equity section, we'll report owner's capital. The contents of the owner's capital will come from the owner's capital statement. The owner's capital statement will be increased by investments from the owner. It will also be increased by net income or subtracted by net loss, which will be a negative number. The net income reported here comes from the income statement. The formula for the income statement is revenues minus expenses. The last component in this box for the owner's capital statement is drawings. Drawings represent the cash that the owner takes out of the business. So let's recap all of this. This big section all represents the balance sheet. This box right here represents the statement of owner's equity or the owner's equity statement. This box right here represents the income statement. Now we can see how all the financial statements are interrelated. The income statement affects the owner's equity statement, which affects the balance sheet. That means that every single transaction, regardless if it's revenue, expense, drawing, cash, notes payable, it will always affect the basic accounting equation, assets equals liabilities plus owner's equity. For example, when we make a sale, we will have revenues go up. If we receive the cash right now, we'll have cash go up. Revenues are going to go up, cash is going to go up, both of these are going to go up. Our equation remains in balance. Let's look at another example. Let's say that the owner takes cash out of the business. We're going to see assets go down and the drawings affects owner's equity, which makes owner's equity go down. Let's say that we're going to pay salaries to our employees. We're going to pay them right now for the work that was done this week. Cash is going to go down. Expenses are going to cause owner's equity to go down because expenses causes our income to go down, makes this smaller, which makes this smaller, this goes down and this goes down. So every single transaction will balance our accounting equation, and it will all be reported on all of these three statements: the income statement, the owner's equity statement, and the balance sheet. I hope that helps you understand the interrelations between the financial statements and how every transaction will affect our basic accounting equation.